All right, stop scrolling for a second because something big is happening right now in silver, and it's happening fast. In less than a week, we just watched silver collapse from $121.64 down into the low 80s, with spot hovering around $81 to $82 as I'm recording this. That's roughly a 33% drop in days. But here's the part most people are missing. The real trigger isn't just selling pressure or bad headlines. The CME just confirmed a roughly 36% margin hike on silver, and it goes live tonight. Stay with me, because I'm going to show you what this actually means, why today's close matters more than the headlines, and how you can recognize this pattern the next time it shows up. If you're holding silver right now, or if you've been watching this move wondering what just happened, your job is to understand the mechanics behind what looks like chaos. Because once you see the pattern, you'll never look at market crashes the same way again. Before I explain what caused this move, let me teach you something most people never really internalize about markets. Price doesn't move just on opinions. It moves on plumbing. It moves on leverage, collateral, and the rules of the game changing mid-play. And I know that sounds abstract, so let me make it real for you. Think of the futures market like driving on a highway with cruise control set. As long as fuel is cheap, everyone's cruising along at whatever speed they want. But when the price of fuel suddenly jumps overnight, some drivers don't slow down by choice. They run out of gas. That's what margin is. It's the fuel that keeps leveraged positions alive. And when the exchange raises the cost of that fuel, the weakest hands don't get a vote. They get forced out. They don't get time to think it over. They don't get to wait for better conditions. They sell, or the exchange sells for them. And that's not theory. That's how futures markets actually work. Now, when we talk about margin in futures, we're talking about the collateral you have to post just to hold a position. It's not like buying shares of stock outright. You're controlling a massive contract with a fraction of its value. Let's say you want to control 5,000 ounces of silver through a futures contract. You don't pay the full value up front. You post margin, maybe $15,000, maybe $20,000. That gives you exposure to hundreds of thousands of dollars worth of silver. That's leverage. That's power. But it's also risk, because if the market moves against you, or if the exchange changes the rules, you need more cash immediately. And if you can't deliver, you're out. So what does that tell us? It tells us that margin isn't just some technical detail. It's the pressure valve on the entire system. And when that valve gets turned, things break. Now here's what's actually happening right now. The CME group raised margin requirements on precious metals, including silver, by about 36%. That means if you're trading silver futures with leverage, you suddenly need to post a lot more cash just to keep the same position open. And here's the brutal part. You don't get weeks to do it. You get hours, maybe a day. So when that announcement hits into an already panicked market, the sequence gets ugly. Traders who can't post collateral sell. Their selling pushes price lower. Lower prices trigger more margin stress for the next guy. That forces more selling. It feeds on itself. And because this is happening into thin liquidity, especially late in the session or overnight, the moves get exaggerated. You get drops that look insane because there aren't enough buyers to absorb the wave of forced liquidation. It's not that silver suddenly became worthless. It's that the mechanics of the market created a feedback loop that crushes price in the short term. But here's the part that should make you pay attention. What makes this even more intense is the timing. Silver was already down hard from that $121.64 peak. Liquidity was already fragile. Traders were already nervous. Then you layer in reports about concentrated positioning, chatter around JP Morgan Chase exposure, temporary disruptions at the London Metal Exchange, and even systems issues reported at HSBC. Now, are those coordinated? Exchanges and banks say no, and I want to be clear about that. I'm not here to sell you conspiracy theories, but whether coordinated or not, the convergence matters. When multiple stress points hit at once, leveraged players feel it first. And that's usually retail and smaller funds, not the deepest pockets. The big institutions, the ones with balance sheets the size of small countries, they can weather margin calls. They have cash reserves. They have credit lines. But the average trader? The momentum fund that went all in? They don't have that cushion. So they're the ones forced to sell into a falling market. Now let me show you what most people are missing. This is forced liquidation, not evidence that industrial or monetary demand just evaporated overnight. Silver didn't suddenly stop being used in solar panels. Central banks didn't announce they're abandoning precious metals. The fundamental case, whatever you believe it is, didn't change in 6 days. What changed was the cost of staying in the game. And that's a crucial distinction. When you see a 33% drop and headlines screaming panic, your instinct might be to think something broke fundamentally. But when you dig into the mechanics, you realize something broke technically. The market structure broke. Leverage broke. Forced sellers overwhelmed willing buyers. That's a different animal. And it resolves differently. Let me give you the confirmation layer that makes this even clearer. When margin hikes hit, you can track the sequence in real time if you know what to look for. First, you see volume spike. That's forced selling hitting the market all at once. Second, you see volatility explode. Price swings get wider because there's no natural equilibrium, just waves of liquidation. Third, you see open interest drop. That's positions getting closed, not by choice but by force. And fourth, you see the move accelerate into certain time windows. End of session. Overnight. Right before the margin deadline. Those aren't random patterns. They're mechanical. They're predictable if you understand the system. And right now, we're seeing all four at once. Volume spiked as silver broke below $90. Volatility is off the charts. Open interest is collapsing. And the worst moves are happening right into the close and overnight sessions. That's not panic. That's the market clearing out leveraged positions under duress. And here's the convergence proof. If this were just a normal sell-off based on changing fundamentals, you'd see it spread out over time. You'd see distribution. Sellers would take profits gradually. Buyers would step in at perceived value levels. But that's not what's happening. What we're seeing is a knife drop, a cascade. That happens when the selling isn't discretionary. It's forced. And the margin hike is the match that lit the fuse. Without that catalyst, you probably get a correction. Maybe silver pulls back to $100, $105. But with the margin hike hitting into already nervous conditions, you get a liquidation event. And those are violent, they're fast, and they overshoot. Now, before we go further, let me give you some historical context, because this is the exact same playbook we've seen before. Go back to 2011. Silver screamed higher that year. I mean, absolutely ripped. It went from around $18 at the start of the year to nearly $50 by late April. Everyone was euphoric. Silver bugs were calling for $100, and then the CME stepped in. They raised margins. Not once, not twice, 5 times in about 2 weeks, 5 times. Each hike triggered violent downside as leverage got flushed out. Silver went from $50 to $35 in days, then lower. And the whole way down, people were screaming manipulation. Maybe it was, maybe it wasn't. But here's what we know for sure. The margin hikes forced sellers into the market. Those sellers drove price lower. And once the leverage was flushed, silver eventually stabilized and found support. Same pattern we're seeing today. The names change. The prices change, but the sequence is identical. Or look at March 2020. That's an even better example because it wasn't just silver, it was everything. COVID hit, markets panicked, and margin calls didn't just hit stocks, they hit gold and silver too. You know what happened? Gold and silver fell. Not because nobody wanted the metals, not because the fundamental case for safe haven assets disappeared, but because everyone needed cash at the same time. Funds were getting margin calls on their equity positions. They had to raise cash fast, so they sold what they could sell. They sold liquid assets, gold, silver, treasuries, anything that had a bid, and prices collapsed even though, theoretically, those were the exact assets people should have been buying in a crisis. But forced liquidation doesn't care about theory. It cares about cash. And once that wave of selling exhausted itself, what happened? Gold and silver bottomed and ripped higher. They went on to make new highs later that year. Every time this happens, the first phase is chaos, the second phase is stabilization, and only later do fundamentals reassert themselves. In fact, when you zoom out, you see the larger story isn't panic. It's mechanics. These liquidation events are painful. They're brutal if you're caught on the wrong side. But they're also temporary. They resolve once the structural pressure lifts. And that's what I want you to internalize. This isn't your grandfather's bear market where sentiment slowly shifts and fundamentals deteriorate over months. This is a technical washout driven by rule changes and leverage. Those resolve faster. They're sharper. But they're also more predictable if you know the signs. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Is this manipulation? Is this a coordinated smash by big banks trying to cover short positions or suppress prices? Here's the honest answer. You don't need a conspiracy for this to break markets. Rule changes alone can do it. Margin hikes are a blunt instrument. They hit everyone, but they hurt the most leveraged first. So instead of focusing on motives you can't prove, focus on signals you can observe. Who's being forced out? How fast is volatility expanding? Does volume spike into the close or fade? Is open interest collapsing or holding? Those are the questions that matter. Those are actionable. Those are repeatable. Could there be coordination? Sure. Could big players use these moments to their advantage? Absolutely. But whether that's true or not, it doesn't change what you need to do. You need to understand the mechanics. You need to watch the signals. And you need to make decisions based on probabilities, not on unverifiable theories about who's pulling the strings. Here's the thing. It doesn't actually matter whether this was orchestrated or organic. The outcome is the same. Leverage longs got crushed. Price fell hard. And now the question is, what happens next? That's what you can control. That's what you can prepare for. So instead of getting lost in debates about manipulation, get focused on where support might come in, how much more forced selling might be left, and what your own risk tolerance looks like. That's productive. That's useful. The rest is noise. There are probably 3 types of people watching this right now. Some of you are long silver and feel like you just got punched in the chest. Maybe you bought at $110. Maybe you bought at $95. And now you're watching it trade in the low 80s and you're wondering if you made a massive mistake. If that's you, breathe. Seriously. The key question isn't what you believe about silver long term. It's whether $80 to $82 holds into the close and after margins take effect. If it does, you might be looking at ADI forming process. If it doesn't, you need to be prepared for another leg lower, maybe down to $70 to $75. That's the final washout zone if this gets worse. And I know that's hard to hear, but hope isn't a strategy. You need to know your levels. You need to know at what price you're wrong, and you need to be honest with yourself about whether you can handle more downside. Because forced liquidations can overshoot, and just because something's cheap doesn't mean it can't get cheaper in the short term. Others of you are sidelined, watching this like a car crash, wondering if this is the opportunity of a lifetime. Maybe you've been waiting for a pullback. Maybe you believe in silver long term, but you didn't want to chase it at $120. And now you're seeing 80 and you're tempted. If that's you, patience is your edge. Forced selling often overshoots, but it doesn't ring a bell at the bottom. You don't get a notification that says, hey, all the weak hands are out, time to buy. It doesn't work like that. What you can do is watch for stabilization. Watch for volume to dry up. Watch for volatility to start contracting. Watch for price to hold a level for more than a few hours. Those are signs that the forced selling is exhausting itself. And if you're going to step in, do it in stages. Don't go all in on the first bounce. Scale in. Give yourself room to be early. Because catching falling knives is dangerous, even when you think you know where the bottom is. And then there are traders looking to short weakness. Maybe you shorted at $100 and you're writing this down. Maybe you're looking to add to shorts here. If that's you, respect the risk. These moves can reverse just as violently once selling pressure exhausts. We've seen it before. A market can drop 30% in a week and then rip back 15% in 2 days once the liquidation is over. So if you're short, have a plan. Know where you're taking profit. Know where you're cutting risk if this reverses. Don't get greedy. No matter who you are, the universal rule is the same. Don't confuse volatility with information. Just because price is moving doesn't mean the story changed. Sometimes the move is the story, and right now the move is mechanical, not fundamental. So here's what I want you to answer in the comments. Where are you in all this? Are you long and holding? Are you sidelined waiting for clarity? Are you trading the volatility? I want to hear how you're thinking about this because the best insights come from community. And if you're feeling lost, that's okay too. This stuff is hard, but that's exactly why you're here. You're trying to learn. You're trying to get better. And that mentality will serve you well. Now let me tell you where I stand. I'm not euphoric and I'm not panicking. I'm watching 3 things very closely. First, I'm watching whether silver can hold that $80 to $82 zone into and after tonight's close. If it holds, that tells me forced selling is starting to exhaust and buyers are stepping in at these levels. If it doesn't hold, if we see another flush lower overnight or tomorrow, then I'm watching that $70 to $75 range as the final capitulation zone. That's where you'd expect the absolute weakest hands to puke out. Second, I'm watching volatility. Right now it's sky high, but if volatility starts to contract over the next few sessions, that's a sign that the market is stabilizing. It means the uncertainty is fading. It means people are starting to find equilibrium again. And third, I'm monitoring open interest. If open interest keeps collapsing, that confirms we're still in the forced liquidation phase. But once it stabilizes or starts to rebuild, that tells you new positions are coming in. That's constructive. That's a sign the technical damage is getting repaired. Based on my analysis, this move was structural. It was mechanical. It wasn't random emotion or a fundamental shift in the silver market. The CME raised margins by 36%. That forced leveraged longs to either post more cash or sell. Most couldn't post, so they sold. That selling fed on itself in thin liquidity, and the result was a 33% drop in less than a week. But here's what didn't change. Industrial demand for silver is still there. Solar panel production didn't stop. Electronics manufacturing didn't stop. Jewelry demand didn't evaporate. And if you believe in the monetary case for silver, that didn't change either. Central banks are still printing. Deficits are still massive. Inflation concerns are still real. The fundamentals are intact. What broke was the market structure, and market structure repairs faster than fundamentals deteriorate. If history rhymes and silver stabilizes here or after one more flush lower, the move that follows could be significant. Not because I'm predicting it, but because that's what happens after forced liquidation events. The selling exhausts, the weak hands are out, and then the market has room to move higher without all that leverage hanging over it. We saw it in 2011. We saw it in 2020. And we might see it again now. But I'm not telling you to buy. I'm not telling you to sell. I'm telling you to watch the signals, watch the levels, and make your own decisions based on your own risk tolerance and your own analysis. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the CME announcements yourself. Look at the charts yourself. Don't take my word for it. Don't take anyone's word for it. Think critically and make informed decisions. If you made it this far, you're the kind of person who wants to understand markets, not just react to them. You want to see the mechanics, not just the headlines. That mentality will serve you well. It'll keep you calm when others panic. It'll keep you skeptical when others get euphoric. And over time, it'll give you an edge. So keep learning, keep questioning, and keep thinking for yourself. If this breakdown helped you see what's really happening in silver right now, share this video with someone who needs to see it. Hit subscribe if you want more real-time market analysis that cuts through the noise. And drop a comment below with your thoughts. I read every single one. Stay sharp out there. Think critically, verify what you hear, and make your own decisions. I'll see you in the next one.